US Big Tech Market Outlook presentation from 1 to 2 p.m. We will then move on to Hong Kong and China Market Stock Picks presentation from 2 to 3:30 p.m. You can take a look at the agenda stated on the screen. We still have some time before the webinar begins, so just sit back and relax until our speakers begin. Just a general reminder that we will be taking in questions from the Q&A tab during the Q&A session later. Do raise any questions you have over there. You may also upvote other participants' questions. Questions with the highest number of votes will be picked earlier by our speakers. We will flash our ongoing promotions while waiting for the speakers to get ready. You may scan the QR code to find out more about the promotions. For more information about these promotions, please visit our website under the promotion page. Okay, without further ado, let's start the webinar. For the US Big Tech Market Outlook, we have our research analysts, Jonathan Wu and Ambrish Shah, to present for us. Let's welcome them.
Thanks, Olivia. Give me a sec to share my screen. Okay, great. Good afternoon, everyone. Thanks for spending your Saturday afternoon with us. My name is Jonathan Wu, Senior Research Analyst at Phillip Securities Research. And together with my colleague Ambrish, we'll be kind of running through just what's happened in the US markets so far this year. I'll also be giving you a little bit of an outlook into what we expect, or our views on what we can expect over the next couple of quarters. So without further ado, let's just begin. Just a general disclaimer. So a brief outline of this webinar. First, we'll run through the market performance, some macro outlook, which will be followed by sector themes, and we'll end off with FAANGMs. We'll just be running through each company individually. So in terms of market performance, everybody knows that this year has been a really bad year for equities. S&P was down about 20% for the first half of this year. Interestingly enough, it was down about 17% in the last quarter, so in Q2 alone. The Nasdaq was down 29%, down 24% last quarter. Gold remained relatively flat, with commodities the main kind of winner for this year so far. Although we do think that commodities looks a little bit like it's tapering off and rolling over. As you can see, it was down about 14% in the month of June alone. And one of the reasons for this is we think that it's because oil prices have been declining, especially around recession fears, and there's also a little bit of uncertainty surrounding its demand from China. Interesting to note is that RK, which mainly compromises of profitless tech, was down only about 4% in June, but is overall down 56% for the year. In terms of sector outlook, or rather sector breakdown, growth sectors lagged seriously in the first half of 2022. Energy was the main winner, up 31%. And this is largely because of surging oil prices. The energy sector is dominated by oil and gas companies. When you look at the top of the table, defensive sectors like utilities, consumer staples, and healthcare are kind of leading the way. And this is usually true when as defensives kind of hold up a little bit better through market downturns. When you look at the bottom, your growth stocks, growth sectors, technology and communications are your main laggards. They're down 27, 29% for the year. With consumer discretionary pretty much obliterated for the first half of this year, mainly due to fears of falling consumer demand and consumer spending. So right now, what we've been seeing is that there's a significant risk-off sentiment in the market. Over the first half of this year, the dollar index has been rising significantly, while the overall US equity market has been falling. And this is kind of usually the case. More people are a bit more fearful. They want to hold they want to take their money out of equities and bonds, and they're just holding cash for right now. In terms of the Nasdaq's performance, for this year, from peak to trough, it's been down about 32%. So rather uninspiring. And it's been actually slightly more than the drop during COVID in March of 2020. But when you compare it to the dot-com crash and the GFC, in the dot-com crash, tech stocks were down about 82% from peak to trough, although it did take them about 2 years to get there. In terms of the GFC, stocks were down about 51%. So for right now, tech performance is really not as bad as the GFC, and not nearly as bad as the dot-com crash. So this kind of chart is just a breakdown of individual stocks in the Nasdaq, and what we're seeing is that profitless tech companies are kind of seeing the biggest sell-offs year to date. When you look at the top, Activision is right up there, and this is mainly because of its acquisition by Microsoft. And surprisingly, Chinese ADRs are also positive for the year compared to the rest of the companies. Big tech is somewhere in the middle, down about 20 to 25%. So Apple, Microsoft, and Alphabet. And that's actually followed by semicon stocks, which are down about 40 to 50%. And last but not least, at the bottom, you see a lot of the profitless tech names like Teladoc, Roblox, Sea, and Coinbase. They're down quite significantly for this year. So we take a look at this chart. It's kind of what we're just taking the tech bubbles that we are seeing right now that have burst, and just comparing it to what happened during the dot-com bubble in 2000. So if you take a look at this chart, the blue line is actually the NASDAQ index over the period of 98 to 2001, 2002. You can see that 2 years prior, up until the peak, it grew about 3.5 times. And in the year following, it dropped off quite significantly to about 1.3 times its, so only about 20 to 30% more than what it was, 2 years prior to the peak. It's a similar story for ARK. So ARK peaked about sometime in January last year. And so 1 year after that, it's kind of been tailing off a little bit and dropping off quite significantly. The biggest bubble that we're seeing right now is actually from Bitcoin, which peaked in October of 2021. So from 2 years prior to its peak, it grew about 6.5 times. And I guess it hasn't been a year since then. It's only been about 7, 8 months since then. It's dropped off quite significantly. And so if you do expect, or if you do want to follow the trend of other tech bubbles bursting, there is still some downside left for Bitcoin. So we'll just run through, what are some of the reasons for the weakness in the market so far. The first reason everybody would roughly know, the surging inflation and rising interest rates. So this is a chart of the PCE, the line in blue, versus the federal funds rate, which essentially is your interest rate in red. One of the reasons why we use PCE instead of CPI is because of the wider coverage. There's a bit less volatility, and also includes non-urban households. So right now we're seeing inflation at about, or rather PCE at about 6.5%, compared to its average of about 2%. And what we're seeing from the Fed is that they're just really hiking interest rates accordingly. They've got a really hawkish stance, and they've reiterated that they're not going to be slowing down until inflation starts coming down. So right now there is this fear of the unknown. No one's really sure how much they're going to raise rates by. Before the last CPI numbers this week, everyone thought that during the next Fed meeting they were going to raise about 50 to 75 basis points. But after this past CPI numbers, everyone is expecting a 75 to 100 basis point hike. In terms of one of the main worries that we're seeing is that as inflation starts to come down, hopefully, and we do see some reasons for it. Firstly, core CPI numbers are flattening out. The numbers from used cars are dropping slightly, and home sales are also dropping significantly. At the same time, oil prices are dropping. I think they dropped about 20 to 25% in the last month, and one of the reasons why it doesn't really pick up in these like your CPI, your PCE readings is that usually these numbers are looking backwards. They're not a accurate representation of what's happening at this moment in time. So one of the main worries is that as inflation starts to kind of stabilize, the Fed, and its hawkish stance is going to be a bit too aggressive in raising rates, especially with the fear of a recession right now. One of the main issues is that the hiking of rates at a rapid pace will cause a really hard landing for the overall market, and that's something that we don't really want to see moving forward. One of the other reasons for the kind of downturn in tech stocks is that we're seeing a devaluation of tech companies across the board. There's an emphasis placed on companies that are already profitable, but we're also seeing compression in earnings growth. A lot of companies over their first quarter 22 earnings calls, and since then they've been revising their growth expectations for the year. And it's one of the reasons why a lot of analysts also believe that that a lot of tech companies shouldn't be valued as high as they were previously. So if you look at this chart, it's just a forward PE of the NASDAQ index in general. Right now we're around 20 to 21 times forward PE, which is roughly the average of its 10-year, its 10-year average of 21 times, and surprisingly, is actually below pandemic low levels in March of 2020, when everyone was kind of freaking out in the market because of the pandemic. This is a chart of the consumer sentiment index. Right now, it's at all-time lows. It's, at least for over the last 25 years. The reading is about 50 right now. You can see in this chart in the middle, during the GFC, when everything was looking very bleak, the consumer sentiment index was still higher than what it is right now. So it is just very interesting to see, because everybody is worried about a recession and weakening consumer demand. However, surprisingly, the US labor market is still very strong, even as sentiment is really low, which is very unusual. Usually when the consumer sentiment index drops, the labor market also gets significantly weaker, or rather, I guess the labor market would be significantly weaker, and that is why one of the main reasons why sentiment drops as well. So moving on, what kind of tech trends are we expecting and are we seeing? So the first would be US streaming shares. In terms of streaming, it continues to take share from other forms of traditional TV like cable and broadcast. You see this chart on the over here, the blue kind of graph is actually your streaming share. So in January of 2022, it was about 29% of the total streaming market, or total entertainment market. And in May of 2022, it grew to about 32%. So this kind of growth is actually taking share from its other kind of segments like broadcast and cable, and it should continue to provide tailwinds for the streaming industry moving forward. Within streaming, Netflix is still the leader. Still leads at about 6.8% of total TV time, which is closely followed by YouTube at 6.6%. Obviously, the main differentiators is that YouTube is predominantly free, whereas Netflix is a subscription-based, has a subscription-based business model. The next will be digital ad spend. So you can see the chart on the left is your worldwide digital ad spend, and what we saw over the pandemic is that there was this acceleration in digital ad spending, and we do expect this kind of permanent effect to continue, but we do expect growth to moderate quite significantly. So during the pandemic, from about 2017 to 2021, digital ad spending grew at a compound annual growth rate of about 20%. However, forecasts are showing that over the next 5 years, this is expected to halve to about 10%. And one of the reasons for this is obviously a weakening kind of macroeconomic outlook, at least for this year and for next year. And also the fact that a lot of people, you saw this massive ramp up in 2020, 2021, and it's just expected to cool off naturally. The chart on the right shows the kind of breakdown between desktop and mobile ad spending, and right now, the mobile is dominating, or rather, it's starting to dominate desktop. You can see in 2017, desktop was the main, took up about 56% of overall ad spending, but that has kind of withered down to about 40% right now. And this is kind of a trend that we expect to continue, especially as smartphone penetration rates globally increase. We do expect digital ad tailwinds to continue to support growth in companies like Alphabet, Meta, and Amazon, and your other digital advertising companies moving forward. Even through a market downturn, obviously they are very sensitive to consumer spending, so we could see a slight dip, but then we would expect a significantly quick pickup following that. In terms of spending, services spending is actually catching up. So this is a chart of durable goods versus tourism spending in the US. You can see the line in blue, which is your durable goods. So like your furniture, your home electronic kind of spending. Took a sharp dip during COVID, and then likewise for tourism. But you saw this strong rebound in durable goods quickly after, because everyone was staying at home. People didn't really have any outlet to spend their money, so they just bought. I guess you just keep buying your new iPhones, new laptops, new screens. Things that were also accelerated by work from home culture. Now, what we're seeing right now, and conversely to that, the world was really shut down for quite a while. Tourism pretty much was almost dead for a year. So a complete opposite of the rebound from durable goods spending. What we're seeing right now is that there is this kind of a gradual, but okay, not too gradual, but in the last 6 months, you see this quite sharp pickup in overall tourism spending. So for the last 2 years, it's been pretty gradual over here. And you can see this at this point since January, as the world has opened up quite a bit, and for us in Singapore as well, tourism has started to pick up quite significantly. We do expect this trend to continue moving forward as it catches up to its pre-pandemic levels. And this kind of trend should actually help companies like Booking.com and Airbnb, companies in the travel and service industry. And it's one of the reasons why later on in our stock picks, we also do have Airbnb in there, because we think that it's going to be quite an interesting stock to look at, especially as tourism spending starts ramping up. So moving on to our recommendation of big tech. This is just a forward PE chart of your FAANGMs. Right now, what we're seeing is that the FAANGM forward PE is about 27 times, compared to, which is below its pre-pandemic lows of about 29 times, and also close to one standard deviation away from its 10-year average of about 31.4 times. So what we're thinking here is that it kind of suggests, this chart kind of suggests that the pandemic-induced hype, from an overvaluation from retail investors and analysts overall has subsided significantly. So we think that fundamentals are starting to play a little bit more of a key role now when analysts look at companies. We're no longer in the environment where everyone is looking at growth stocks, hyper stocks that aren't profitable yet. So we think that it's a good sign. It's a relatively good opportunity to start looking at some of these stocks right now. Also, the bar is set super low for the second quarter 2022 earnings, which has pretty much started to come out. So you had the banks over the last couple of days, and we should start to see big tech put out their earnings. I believe Netflix is going to be putting out its second quarter earnings this coming week, followed by the rest of the big tech towards the end of July. So the bar for these earnings are pretty low. So we would expect that any outperformance should really drive quality stocks upward, at least in the short term. So moving on to our individual stocks, the first would be Meta Platforms, and we think that Meta's valuations are currently at an all-time low. One of the benefits for Meta, or rather one of their merits, is that it has a very strong network effect. And it's really one of its key strengths. Users are more reluctant to leave the platform because maybe all their friends are already on it. So if you kind of move over to another platform, and all your friends stay on, there's really no incentive to move, I guess. And their monthly active users are actually one of the key metrics for its core digital ad business. And so the way we look at it is that as long as Meta is able to keep their monthly active users or daily active user numbers high, it should definitely benefit them in its digital ad business. Like I mentioned earlier, the company is trading at historically low valuations, around 12 times forward PE, well below its 10-year average of about 33 times, and also below the Nasdaq's average of about 21 times. So just looking at valuations is really a very attractive opportunity right now. In terms of some of the negatives we're seeing, Apple's privacy changes continue to affect Meta's business model. If you all didn't know, the Apple's ATT privacy changes where and how it affects Meta is that it allows users of your Apple devices to kind of restrict data sharing to third-party apps like Meta and like Google and etc. And so the real struggle that Meta has had from this is that it's had less data to collect from, and which is affecting its efficiency in digital ad targeting. And so people that use Meta, like marketers that use Meta to kind of advertise their products, are seeing diminishing effectiveness of their marketing efforts. For this year, at least for the first half of this year, and we will expect for the next half as well, Meta is actually seeing a large increase in expenses, especially due to tougher competition from companies like TikTok. So all these expenses are going to IT because they're trying to transition their platform into a more short-form video kind of platform rather than how it is right now. And so obviously these kind of transitions take time, but it's nothing that the company hasn't done before. So we do expect this transition to be fairly smooth, except for the fact that they've got to shell out quite a bit of money in expenses. So moving on to Apple, we think that the key to their success moving forward would lie in the services segment. Apple remains a beneficiary of the 5G replacement cycle, all the upgraders from your 4G devices. Especially last year, Apple iPhone sales were off the charts. Although we do expect this to taper a little bit, they still are overall beneficiaries of this kind of upgrading cycle. We think that growth in higher margin services like your App Store and Apple TV continue to be the key to driving overall growth, especially because the margins are so high. Services has been increasing at about 20% year on year for the last couple of quarters and for last year as well, compared to kind of overall revenue growth that has been pretty flat, growing at about 5-6%. So we think that also Apple has strong pricing power. It's been able to pass down most of its costs to its customers. So it's just been raising the prices of its Apple iPhones, Macs, and so on, and consumers seem to be just paying for it. And so this helps to protect their margins, especially as supply chain issues over the last year have kind of caused, or last couple of years, it's kind of caused a lot of prices of your chips and your hardware to increase significantly. So one negative that we see in the short term is that weakening consumer demand may affect sales, at least for this year. And also as customers kind of shift away from, or rather consumers start shifting away from purchasing durable goods like electronics and start spending their money on experiences like travel. Yeah. So that's all for Apple. For Amazon, we think that they will continue to be a beneficiary of continued cloud adoption. And cloud adoption is something that has been going on for the last couple of years. It's been really ramped up by a lot of corporates moving online, especially during this kind of shift in work from home situation. And also because they are the kind of monopoly, or not monopoly, but they dominate the cloud infrastructure kind of competition with Amazon Web Services. They remain an e-commerce monopoly in North America, and this kind of should we expect this to continue for the foreseeable future. So currently, it's trading at relatively low levels compared to its past, but it is still relatively high compared to the average of the Nasdaq's forward PE. In terms of short to mid-term kind of negatives, we expect the company to attempt to deal with its overcapacity and overstaffing issues that was kind of brought on by the pandemic. During the pandemic, there was a surge in demand, and And what Amazon did was to try and keep up was to hire a lot more people, build a lot more warehouses. And right now, as demand is kind of slowing down, you have this excess of warehouse inventories, excess and staff, and so they would have to, or they have begun laying off staff to reduce costs. And they also would be forced to kind of sell a lot of their warehouse inventory at lower margins, which could help in the deflationary kind of environment to curb the high inflation. Moving on to Netflix. Netflix is still kind of in this streaming war with its other streaming players as they grapple for market share. We do think that the company still has relatively strong pricing power, so it's able to increase its prices and kind of add users at the same time. I know the last quarter and this quarter are expected to be pretty bad because of headwinds from the Russia-Ukraine conflict, as well as just overall slowing growth. But we still think that they are able to raise their prices, especially in areas like the Asia Pacific region, where it's actually looking to grow to at least support most of its growth. So it remains the market leader in streaming, producing billions of dollars worth of content each year, even amidst tough competition from Disney, Hulu, HBO Max. We think that it's currently heavily undervalued. It's trading at about 16 times forward PE, well below the Nasdaq's average of about 21 times, and way below its own 10-year average of about 110. One of the negatives is that we see user growth stagnating in developed regions like North America, and also they do have an ongoing issue from password sharing. It mentioned in its first quarter call that it estimates about 100 million subscribers are actually sharing its passwords outside of its household. So if you take $100 million subscribers, that's almost half of their user base. Half of their revenue just leaking away. One thing they're trying to do is implement a cheaper kind of plan for subscribers to allow for this sharing. And they're also starting to introduce they just kind of got into an agreement with Microsoft to start working on a lower cost ad-supported base plan for people that are willing to have ads in their streaming experience, but paying a cheaper price. This should boost revenue moving forward, although we don't really know how long it would take for these services to kind of roll out, and what the experience would be from that. We are still optimistic of Netflix as a streaming company moving forward. We think that as streaming kind of takes over market share from traditional TV players and cable and broadcast players, it should provide headwinds for Netflix especially. Moving on to my last company before I hand it over to Ambrish, Alphabet. So Alphabet is still the dominant it remains the dominant power in digital advertising. It has more than 50% market share. Its ad revenue is also growing at a 5-year compound annual growth rate of 22%. It also remains a monopoly power in many product segments like mobile OS and digital maps. So in terms of OS, there's really only 2 players, iOS and Android. Digital maps, since the acquisition of Waze, I believe most people just use Google Maps. And these are important kind of segments that where it draws its data from to support its ad business. And it's also because of the usage, it's also other outlets for the company to kind of generate more revenue. In terms of its valuation, it's well below its 10-year average. Currently, it's at 17 times, more than one standard deviation below its average of 22 times. So we think that definitely undervalued for right now, worthwhile pickup moving forward. So that's it for our individual stocks, or rather my individual stocks. I'll pass my time on to my colleague Ambrish to cover the last 2 counters. Thank you.
Thank you, Jonathan, and good afternoon, everyone. So for Microsoft, we have titled increasing sales volume and average revenue per user. So basically, Microsoft has two main growth drivers, and they are its productivity software, and another one is its cloud Azure. So the number of users and the pricing for both the segments have been increasing. So Microsoft has a 90% market share in the productivity software market. And this includes Microsoft Office 365, which has a Word, then Excel, PowerPoint, and Outlook, as well as Microsoft Teams. So the key main growth drivers for productivity segment, it would be the economy reopening up, as well as there has been an increasing need for managing the tasks and workflows. So the key driver over here would be that as the offices reopen, the employees would need to go to offices. And so this would drive demand for Microsoft's productivity software, we believe, because more number of users will have to use Microsoft Office 365. Then moving to the Azure. Azure is Microsoft's cloud service, and currently it is the second largest global public cloud provider. So Azure's market share has increased from about 10% in 2017 to about 21% right now. And the Amazon's Amazon Web Services, it is currently the leading player in public cloud, and it has a market share of about 33%. So we believe that Azure will still continue going forward to capture market share from the other peers, mainly because the companies would still digitize their operations and spend on Microsoft's cloud service, as well as there are few reasons that Azure has over Amazon. Like basically Microsoft, it has about 75% of servers right now. It has existing relationships with the current companies. About 73% has Microsoft Windows Server, and the company also claims that its Azure it's about 5 times lower as compared to Amazon, and it also has an advantage like integrating it with the Microsoft Office 365. As well as the COVID-19 pandemic, it has accelerated the shift of migration to the cloud. So the third, additionally, the company also states that its cloud business, it is a high margin business. So as the sales for Azure increases, it would basically also help the Microsoft's profitability to grow. So the third growth driver, also we believe that there have been increasing cybersecurity attacks currently because of Russia and Ukraine wars. And we believe that there would be companies they would upgrade their licenses to a premium and like E5, mainly because to have an enhanced cybersecurity coverage. And so overall, we believe that Microsoft is currently trading at attractive valuations, and it also has an earnings visibility right now with its growth outlook, and also it's not being impacted by the regulatory authorities, federal regulators. It is not being a target like the Google and Facebook. And also we have a target price of about 338 for Microsoft, and from its current market price of about $256.72. Yeah, okay, next slide, please. So this week we initiated coverage on Airbnb, and the report was titled Rising Above Pre-Pandemic Levels. So Airbnb has been rising currently. It has been rebounding from its pandemic-driven drop, mainly because of the travel restrictions have been easing. And if you look at the left-hand side chart, in FY21, the number of nights and experiences booked, it increased by about 50% year on year to about 300 million. And this was just an 8% drop from its pre-pandemic levels in FY19. So, however, its online travel peers like Booking and Expedia, they are still working their way towards their pre-pandemic levels. In 21, Bookings and Expedia, their bookings volumes was down almost like 30% to 40% respectively in FY21. So in FY22, we do believe that there would be an acceleration in bookings volume, mainly because of travel rebound, and Airbnb, we believe that it could reach an all-time high in FY22 with about 400 million bookings volume. And this is like a upside of about 28% from its FY19 levels. We believe that its peers like Booking and Expedia, they would reach their pre-pandemic levels by the end of this year, or maybe early first quarter in 2023. The Airbnb's outperformance, this is mainly because of its leading status, like it's the leader in short-term rental market, as well as it has a unique base of supply. And additionally, consumer spending has been increasing on alternative accommodations. So moving on to the second point, the company continues to innovate the platform, and this is how it differentiates itself from its peers. So it like in FY21, the Airbnb, it released almost like over 150 upgrades and added new features to its platform. And they include like the flexible date search tools as well as air cover. Then in FY21, Airbnb, it spent almost like 24% of its revenues on product development expenses. This is largely outperforming its peers. Booking and Expedia, they almost just spent about 4% to 12% on their product development expenses. So overall, we believe that as the company is innovating its platform and adding new features regularly, it overall improves the user experience, as well as it also helps to retain its guests and hosts. Then Airbnb, we believe that it's on the verge of profitability. We believe that the company, we model that the company can expect report a maiden net profit of about $1.4 billion in FY22, as compared to a 352 million loss in previous year. And the main growth drivers for this would be that the company has been expanding its booking values over the last over the last 21 year or so, because as the travel rebounds, and mainly we also expect its top line growth the revenue to grow by about 38% this year. And this would be fueled by a boom in travel, as more number of people, they would like to go ahead as after following the lockdowns. So overall, we have a target price of $119 on Airbnb, and it has a current target price of about 94%. So it's like an upside of 25% right now. Yeah, that's all for me now. And let us move on to the Q&A session now.
All right, thanks, Ambrish. I'll take some questions. Let me stop sharing real quick. All right, so I'll take the questions that are most voted. The first question here is, what is the outlook of the US dollar versus the Sing dollar in the next 30 days? So I'll try to answer this as best as I can. But in terms of the US dollar strengthening, you know, I previously showed a chart of it strengthening quite significantly over the last 6 months. And we do expect this to continue rising, especially with you know, the continued tightening of fiscal policy in the US. I do also understand that the Sing already, or rather, the MAS has also raised rates or tightened their fiscal policy in Singapore as well, which caused a kind of quite a sharp increase in the Sing dollar. However, we do expect that just due to the scale of how much the Fed is tightening its policy, we still do expect the US dollar to strengthen fairly significantly, at least for the next quarter, compared to the Sing dollar. I think the next question is for you, Ambrish. What are your thoughts on Adobe? Maybe you can take that.
Yeah. So for Adobe, we have a target price right now of about $549. So we do believe that Adobe, it's an upside of like about currently trading at 379. So it's a upside of about 40% or so. And we do believe that there are tailwinds for Adobe. So first one would be that content creation has been rising right now, and every company, it wants to have a digital presence. Additionally, there have been a paper to digital transition. So another tailwind could be that the company's Creative Cloud products, the pricing has been increased in the second quarter. So the company, it should reflect in the financials maybe in the second half of 2022. And additionally, there have been a cloud migration trend. Company like they have been going to the cloud, and it also has partnered with, it acquired a company iframe.io, and it helps to collaborate all its work tasks and flows through the cloud. That's it.
Okay, so I'll take the next few questions. Now with the dollar and the euro flipped, what can we expect its impact on the stock market? So in general, I guess the US dollar has been strengthening for the last almost 1 year, and as it continues to strengthen, a lot of American businesses that are listed in the US, they do have a lot of exposure to these fluctuations, especially as they have a lot of operations outside of the US. And so this will definitely hurt earnings because it's just FX headwinds that these companies have already been mentioning since I believe their fourth quarter earnings call last year. So we would expect this to continue. We would expect this to continue to be headwinds for earnings for most of the international companies, or rather most of the US companies that have international operations moving forward. In terms of the specific US dollar euro kind of flipping, I don't really think I have any comments on that specifically as to how it would impact the stock market. The next question would be on interest rates. On the topic of interest rates, where is it headed, and if you believe it will continue to rise, is there a risk of stagflation? Yeah, so I'll pull up the chart on interest rates. Yeah, so you see right now, it's about 1.75. We do expect interest rates to hit about 3.5 to 3.75% by the end of the year, which is quite a significant increase from right now. However, we don't really think there's a risk of stagflation. One of the main reasons why is that the job market is very healthy. There are, even though when you read the headlines, you hear about a lot of big tech laying off its employees. The overall job numbers continue to be good. There's excess of jobs out there in the market. So we do think that this would help to prevent stagflation, at least in the mid-term, short to mid-term. I think something that it would be a bit more concerning would be a continued environment of high inflation. I think that would be a bit more worrisome. As if the inflation remains really high at elevated levels, it's going to deplete a lot of people's savings, and we don't think that it would be, if the Fed continues to raise rates and continue its tightening policy, we think it would be we think that kind of addition to an already high inflationary environment would be very, very dangerous for the overall economy. People are going to be depleting their spendings because they're going to have to be paying so much more for petrol, so much more for your food, just so much more for everything in general. But in terms of stagflation, we still think that the job market, the labor market is very healthy. We don't think it's going to go into a stagflationary environment anytime soon. Next question is on streaming. Even though streaming spend is going up, Netflix is facing competition from Disney Plus, Hulu, Amazon Prime, Apple TV, and has experienced declines in subscriber base. Is Netflix still a good buy in the streaming segment? Yeah, so let me move it to Netflix. Okay, yeah, so in terms of streaming, like I mentioned earlier, Netflix is still the market leader. They do have competition from Disney Plus, but when you really look at it, Disney Plus, their initial kind of pricing was, or it's about half the price of your Netflix subscription, and the number of subscribers that it has is also about half of what Netflix has. So we don't really see that much competition from them in terms of a revenue generation standpoint. At the same time, we think that the main differentiator for Netflix is that maybe a couple of years ago, they used to be a lot of their content spending would go to content that was produced by its competitors like Disney, like HBO, like Amazon. But for right now, they've kind of flipped this on its head. Most of its spending is going towards its own content, original productions, original content productions, and these original productions are actually gaining a lot of popularity. It's winning a lot of awards, and it's definitely proving to be better entertainment for compared to its peers in general. In terms of declining subscriber base, like I mentioned earlier, the main issue they're really facing is password sharing, which is going to be very difficult to overcome. But we do like the fact that they are moving into, or rather trying to create a new lower price digital ad supported kind of platform. This should be able to boost its margins quite significantly, which should help its earnings. The one main caveat from that is that we think that they also might cannibalize some of its other subscription plans, like people who are just on a basic plan, maybe that's priced higher. Maybe they don't want to pay $10 or $12. So they rather pay $6, and so you lose that subscriber from that particular plan. At the same time, it also is to be determined, how much digital ad revenue they can gain from it, because a lot of the ad revenue is linked to how many users you have, how many subscribers you have. Okay, so the next question is, what is your thought about NVIDIA going forward? So we don't really cover semicon stocks, so I can't give you a rating on it. But in my view, semicon stocks like NVIDIA is obviously the leader right now. They're heavily tied to a lot of growth stocks. So when you believe that growth is starting to look more attractive, and NVIDIA is starting to look attractive, then you can definitely pick it up, because in terms of business fundamentals, they are very strong. One key thing to take note of is supply chain constraints. So right now we are starting to see a little bit of easing in terms of supply chain issues. We do expect this to definitely benefit semicon stocks like NVIDIA. Although if consumer demand continues to weaken, then you would see the demand for a lot of your durable goods go down, and then eventually sales for revenue for NVIDIA would kind of follow that trend as well. What is your year-end 2022 target for S&P? Sorry, we don't put a target. We don't have a year-end target for that. Next question, is PayPal oversold? Though there is weak guidance for near term, but it still remains very profitable. What is the long-term outlook for PayPal, considering competition from other fintech and possible recession? Yeah, so we also don't cover PayPal, but I'll try my best here. PayPal as a business is definitely a good business in my view. There is, like you mentioned, there is increasing competition from a lot of other fintechs, especially from Block, who used to be called Square. But we do think that because PayPal was it was the pioneer in all these online payments, so it is heavily entrenched in a lot of corporates, and as well as I guess equally as much consumer payments in the US. So we do think that PayPal, even amidst tougher competition, should be able to outperform its peers, and over the long term, over the mid to long term for sure. Yeah. So next question is what about the semicon industry? So like I mentioned earlier with Nvidia, semicon industry is heavily tied to your growth stocks, to a lot of your durable goods. Generally, if there's a recession or if there's weakening consumer demand, then supply chain issues continue to abate, then we would think that the semicon industry will be continue to be the laggard, at least until demand goes up and supply chain kind of eases off to relatively normal levels. Okay, so
want me to take on a few questions on Airbnb?
Yeah, sure, Amrish, jump on in.
Yeah, thank you. So there was a question like, how would Airbnb perform with performance with respect to bookings and Expedia, as well as another one was Airbnb travel is discretionary spending. Wouldn't the recession fears curb consumer travel spend and affect Airbnb revenue growth in the next 2 quarters ahead? So we do believe, and we have factored in these risks, that Airbnb, it could be impacted by a surge in COVID-19 cases, as well as high inflation and recession fears. So we do believe, but there would be a growth in revenue for Airbnb, mainly because it has a first mover advantage. It has been upgrading its products, and also consumers, they prefer like Airbnb houses to be a more safer options right now. And as a result, the spend is more alternative accommodation as compared to a hotel industry. So this is the main reason that bookings and Expedia, they are expected. We expect them to grow at a slower pace as compared to Airbnb, both for its bookings volumes as well as its revenues. We expect them to reach to their pre-pandemic levels by the end of this year, or maybe, as I said, in early 2023. There was another question with respect to Airbnb's user profile, country profile, competitors, sustainability, and financial strength. So Airbnb, they don't, bifurcate their user profile basically. The country profile, in terms of country, Airbnb, it generates like about 52 to 53% of its revenue in North America, and 32% from the EMEA, Europe, Middle East, and 7% from Latin America, and the remaining 7% from the Asia Pacific region. And in terms of financial strength, the strong demand rebound in its revenues as well as booking values, we expect the company to be profitable in 2022. So there was another question for Microsoft, like what does ARPU stand for per user for Microsoft slide? ARPU, I'm really sorry if I missed it. It's an acronym for average revenue per user, and that's basically like how much the company would earn per active user. Over to you, John. Thank you.
Thanks, Amrish. Yeah, so there's a question here on banks. Unfortunately, we don't cover banks, but I guess I can try to give an answer to this. Is US banks a buy as interest rates are going up? Which in particular, BOA, Wells Fargo, or Citi? So in terms of interest rates going up, it's definitely going to be beneficial to the banks. Surprisingly, the bank stocks have performed really poorly over the last 6 months. I'm not entirely sure why, but in terms of US banks, you have a wide range of them. You've got your investment banks, you've got your PBs, and then you've got your private banks, and then you've got your general consumer banks like Bank of America, Wells Fargo, or Citi. I would refrain from picking any of those, or rather one of those three. I think all of them are pretty good companies to buy in rising interest rate environments, especially after the sell down over the last few months. So in general, the short answer would be US banks in general are pretty good. You just have to pick, whether you think the investment banks are good, your consumer banks are good, or your private banks are going to be performing better. Next question here: what are the signs to look out for that would indicate a recovery for tech stocks? I think the main sign that that would really drive tech stocks up would be the Fed stopping its rate raising policies. I think once the Fed starts becoming a bit more dovish, then you're going to see a more risk-on kind of environment in general, and all the money is going to be funneling towards your risk-on kind of stocks, like growth stocks and tech stocks. Other kind of catalysts you can look at would be earnings. Actually, once the second quarter kind of earnings start coming out, you'd probably be able to get a feel on how these tech stocks are going to be doing in the short term, just based on how the tone is, how their performances has been over this past quarter, especially because this quarter is expected to be a really bad quarter for almost all tech stocks. The next question is, so please comment on gaming stocks such as Roblox and whether this is a buy. Unfortunately, we don't cover gaming stocks, so I don't think I have much to comment on this particular question. Sorry. Well, let me take this one. What is your view on C moving forward? Especially its price has been dropping so much while its businesses are still in line with current market trending. Yeah, so for C, it's a bit tricky, mainly because they are still not profitable, and right now the market has been placing a lot of emphasis on profitable companies. Also, it doesn't have a lot of good news in the headlines. It's always like they're closing an office here or there. But the thing about them closing offices is that they like to test markets, and so the way they test markets is they open these small offices just to get a feel on whether their business model will work in that particular region and that particular country. So they've been doing this opening and closing of offices quite a lot. Unfortunately, a lot of investors read this and start selling it off just because of bad news. But in terms of business model, they're also in markets that are very competitive. So like e-commerce. So their Shopee platform. It is the #1 e-commerce platform in Southeast Asia. But it is in a very competitive environment, especially with a lot of big players like Alibaba and JD. In terms of its gaming business, its #1 kind of product, its #1 game, Free Fire, is kind of slowly dying off, especially after its ban in India. So we think that some of its businesses, is going to definitely have to focus more on its digital financial business, so like C-Money. I think that will probably be the next driver of growth for them, and as well as their e-commerce business in Brazil that has been picking up quite a bit. So I think we have about time for just one more question. So I'll pick up a question, unless you have any questions you want to answer, Ambrish.
Not really, John.
Yeah. Okay. I'll take this question on Meta and Amazon. The last question regarding Meta, as they are investing a lot into R&D. How does this change their valuation? I'm wondering if it will affect their free cash flow. Yeah, so it'll definitely affect their free cash flow a little bit. I believe last year they had about $38 billion in free cash flow, and so for this year we are projecting quite a bit less, about 30% less, 30 to 40% less, just because they are ramping up their spending on IT. In terms of how it changes their valuation, it doesn't really change that much because their business model is still pretty good. Their revenue is still good. What we would look out for more is whether their users user base is declining or increasing. In terms of Amazon, what kind of effects will the over inventory have on purchases? So for Amazon, it'll be quite interesting to see what the results are for Amazon Prime. Amazon Prime Day that happened last week, to kind of give you an idea on the consumer demand for the short term at least. In terms of over inventory, they would have to price a lot of their goods cheaper to get them sold off. But I don't really think that has any effect on purchases, because if people don't if there's a general weakening in consumer demand, then purchases naturally are going to be decreasing, even if things are cheaper. Yeah, so I think that's all for us right now. I'm sorry we're not able to answer all your questions, but if you do have any questions, please feel free to send it over to our research team. We'll try to answer them and send it over via email. So with that, I just want to thank everyone for your time. Thanks for listening to this presentation. I'll pass my time on to Olivia to carry on. Thank you.
Thank you so much, Jonathan and Ambrish. Okay, everyone, that's all for our session on US big tech market. We'll be having a short break before the next session on Hong Kong and China stock picks. You can choose to leave the webinar, or you can join in later with the same link at 2:05 p.m. See you. Okay, everyone. Welcome back to Strategy and Stock Picks. We hope the short break just now has prepared you for the second half. Now, let us welcome Mr. Louis Wong. Director at Phillip Securities Hong Kong, to present on Hong Kong and China strategy and stock picks. Louis, over to you.
Thank you, Alifia. Good afternoon, everyone. Thank you for joining this session. In this session, I will share with you our strategy and stock picks for the Hong Kong and A-share market. These are the key discussion points I'll go through in the next 1 hour or so. We'll do a review of China and Hong Kong stock market in the first half this year, an overview of China's economy, and our 2022 outlook of on the China economy. And then I'll also share with you our view on the Yuan outlook and our Q3 major index targets. This time round, because I would like to point out that the long-awaited ETF Connect was finally launched on the 4th of July this year. So now foreign investors are will have access to ETF listed on the Shanghai Exchange and the Shenzhen Exchange. So what are the A-share ETF that are worth looking at? Today I'll share three ETF A-share ETF picks with all of you. And then like last time, I also touch upon those underlying stocks that are listed in Hong Kong, which also have DLC, daily leverage contracts listed in Singapore. So we'll explore what are the trading opportunities in those DLC with Hong Kong underlying. Okay, a review of the performance of the Hong Kong and China market in the first half. Shanghai Composite Index was down 6.6% in the first half. But actually, if you compare to the drop of 11.9% in the first quarter, the second quarter, actually, the A-share market has recouped some of the losses in the first quarter. Technically speaking, the Shanghai Composite Index rose to around 3,400 points recently, only kept by the resistance of the 200-day moving average. And in stepping into July, we saw correction, and now the index was trading around 3,200. The Shenzhen Component Index was down 13.2% in the first half this year. But if you compare to the drop of 18.4% in the first quarter, again, similar to the Shanghai Composite Index, the Shenzhen Component Index has paired some of the losses recorded in the first quarter. Also, technically speaking, it met resistance near the 200-day moving average, which is around 13,230. And the recent high was around 13,000. Hong Kong actually moving just sideways, not big change in the second quarter. It was down 6% in the first quarter. So in the first half, the Hang Seng Index was down 6.6%. So basically, the Hang Seng Index was moving in a sideways pattern between 19,000 to 22,500. This is the trading range for the last 4 months for the Hang Seng Index. Hang Seng Tech Index was down 14.1% in the first half, better than the performance in the first quarter. First quarter was down 19.6%. So I will later go through what are the changes in the fundamentals that bring about an improvement in the performance of the Hang Seng Tech Index. Okay, last quarter we had our seminar in April, and we identified these headwinds in our last quarter. So now we will do a review on those headwinds to see which are the headwinds that have improved or deteriorated. First headwind is the Russia-Ukraine crisis. Still no end being seen. It enters its 143rd day today. The Russian Ukraine war. And then US-China relations, also not much improvement seen, although there's meeting between high-ranking, top-ranking officials between China and the US recently, between Wang Yi and Blinken. China passed along the US 4 lists of demands for action, namely updated list of US wrongdoings that must stop, updated list of key individual cases that the US must resolve, list of actions in the 117th Congress of high concern to China, and the list of cooperation proposals in 8 areas, including climate change, public health, and people-to-people exchange. So unless these 4 lists raised by China to the US are resolved or responded by the US, we don't see imminent improvement in US-China relations. Okay, the third headwinds we identified last time was the Federal Reserve getting hawkish. So lately, I think you are aware that following the announcement of the latest CPI, US CPI, which grew by 9.1% year on year in June, there's speculation that the rate hike by the Fed at the end of this month may be in the range of 1% instead of 0.75%. But of course, on Thursday and Friday, there are federal governors as well as officials coming out to say that a rate hike of 0.75% is sufficient. And that explains for the rebound on the US market last night. Okay, the other headwind, which is persistent one, is the COVID-19 surge. Recently, following the lifting of the lockdowns in Shanghai and Beijing, however, China saw a resurgence of cases, as well as this time is the BA.5 variant, which spread faster than the other older variants. Another headwind is property developers default. I think the property crisis in China is deepened following recent reports of home buyers boycotting mortgage payments for unfinished pre-sold units that may spread into financial contagion to the banking system. So this headwind actually has become more deepened due to because of home buyers boycotting mortgage payments. And Chinese stock delisting, yet no resolution has been reached between China and the US. Talks are reaching a critical point as the deadline closes in soon. Finally, there's at least some improvement in this last headwind, that is the tightened regulation on tech companies. We noticed that starting from June or May, late May, early June, there's a change in the stance of the Chinese government. Regulation has been eased and is getting more rational. So that explains why the tech index managed to recoup some of the losses seen in the first half. Just now I mentioned the Hang Seng Tech Index was down 19.6% in the first half. Yet in the first quarter, the index was down 14.1%. So actually, the Hang Seng Index rebounded in the second quarter due to a change in the stance, the regulation stance. Okay. Let's look at China's economy in the first half. China's GDP expanded 2.5% year on year in the first half of 2022. However, because of the COVID lockdown, GDP only grew by 0.4% year on year in the second quarter, lower than the market expectation of 1% growth. Worse still, there was a 2.6% drop in the second quarter GDP compared with previous quarter. So quarter on quarter, it dropped 2.6%. As full or partial lockdowns were imposed in major centers across the country in March and April, including the commercial hub Shanghai. Many of those curbs were lifted in June, but already from April and May, the data, the economic, the GDP growth in those 2 months were adversely impacted by the lockdown. Hence, June data has offered signs of improvement, only starting from June. Going forward, China's National Bureau of Statistics has reservation about the outlook of the economy, warning about the lingering impact of COVID and shrinking demand at home. The Bureau also noted the rising risk of stagflation in the world economy and tightening monetary policies overseas. So this week we saw different central banks raising interest rates, including Philippines, Canada, etc. Okay, real estate investment. This is a fixed asset investment. For the first 6 months, fixed asset investment in China grew by 6.1% year on year, 0.1% lower than the rate seen from the first 5 months. However, this chart on the right-hand side shows that real investment still continues to fall, falling from 4% in the first 5 months to 5.4% in the first 6 months. Okay. It is due to property sales remaining weak. China home prices fall for the 10th month in June, weighing on the performance of property sales. So the chart on the left-hand side shows the property sold in terms of floor area. The yellow line represents the floor area. It was still down 22.2%, although slight improvement from the 23.6% drop in the first 5 months. In terms of value, the property sales in terms of value dropped by 28.9% in the first half, slight improvement from the 31.5% drop in the first 5 months. The chart on the right-hand side shows the confidence is a confidence index of property developers, 国房景气指数, the property developer climate index. So it continued to fall to 95.4 in June, showing a further weakening of sentiment as well as confidence among the property developers. Just now I mentioned the latest development of buyers boycotting mortgage payment. In the past week, buyers of over 230 properties in 86 cities in China have joined together to collectively refuse to make mortgage payments for unfinished pre-sold units. And this worsened fears of financial contagion to the banking system. Related authorities have called emergent meetings to try to resolve the issue. So whether there's any solution to it is yet to be seen now. It is estimated that if every home buyer of those unfinished pre-sold units defaulted, non-performing loans will increase by 388 billion yuan, equivalent to about $58 billion. Okay, the only compared to fixed asset investment, industrial output growth accelerates in June, to a large extent helped by the resumption of manufacturing following the lifting of lockdown that started in June. Industrial output growth accelerated to 3.9% in June as activity began to recover from months of crippling COVID lockdowns. Among the three major sectors of manufacturing, mining, and the production and supply of utilities, the mining sector's output showed the fastest growth, climbing 9.5% year-on-year in the first half. Besides that, the high-tech manufacturing sector also stood out with a year-on-year growth of 9.6%. Okay. Retail sales also rebounded in June as consumers unleashed their pent-up demand after the lifting of some of the lockdowns. Retail sales in June rose by 3.1%, recovering from a prior slump and also beating expectations for no growth from the prior year as consumers unleashed their pent-up demand. Retail sales in June saw a boost from spending across many categories, including autos, cosmetics, and medicine. But catering, furniture, and construction materials saw a decline. We are not surprised to see that the decline in the sales of furniture and construction materials because they are highly related to the property market, which is still struggling. But also need to take note that online sales of physical goods group slowed down. Although it's still growing, but the growth rate slowed down quite substantially to 8.3% from a year ago in June, slower than the 14% growth the prior month. Part of the reason may be the logistics side has not fully recovered prior to the lifting of the lockdown. Okay. While the rest of the world is threatening by higher inflation, by stagflation, inflation in China is also starts rising. CPI inflation rose to the highest level in 2 years. Left-hand side is this is the consumer price index in China. It rose to 2.5%, the highest level in 2 years, and inflation is expected to keep rising in the second half and very likely to surpass the 3% target, official target set by the Chinese government, as the economy recovers from the lockdown in the first, and also the pork price cycle now turns inflationary after a long period of deflation. In just 1 month, from June to July, pork prices in China has risen by almost 30% because the cycle now has bottomed out, and now the pork price is entering up cycle. PPI inflation cooled in June to the lowest in 15 months. You can see on the the chart on the right-hand side. Producer price index rose 6.1% in June, the lowest in 15 months, driven by the resumption of additional industrial production, stable supply chains in key sectors, and also government policies to stabilize commodity prices. Going forward, of both the official PMIs and the HK&CN PMIs indicate China's economy is still on a recovery path, indicating quick recovery of economic activities. The chart on the left-hand side shows the manufacturing PMI. The official one, the blue line represents the official one, the one released by the National Bureau of Statistics, and the purple line represents the manufacturing PMI compiled by HK&CN. So both manufacturing PMIs crossed the 50 mark, rose above 50 in June, first time since February this year, and the non-manufacturing PMI posted the strongest reading since May 2021. So they are in line, both official and HK&CN manufacturing and non-manufacturing PMI. They are in line. We saw a strong rebound. The HK&CN manufacturing recorded a 30-month high, and the non-manufacturing PMIs rose to a 11-month high. Both official and HK&CN indexes indicate a quick recovery of economic activities in the country. Okay, but whether China is out of the wood, the Chinese economy is out of wood, not sure, because this is our outlook, our view on the outlook. While China is on a recovery path as the economy unlocks amid accommodative policies, there are still downside risks from renewed lockdowns and also another recession, as long as Beijing, if Beijing still sticks to its zero COVID strategy and implement further lockdowns. According to a survey, currently regions that account for 25.5% of China's GDP were under some form of lockdown or heightened control. There is also lingering weakness in China's property market. Just now, we show you that property prices fall for the 10th month, and home buyers are now boycotting mortgage repayments on stalled projects. This may deepen the property crisis. And also, another adverse development is aggressive global monetary tightening in other countries and high domestic inflationary pressure. Just now, the CPI chart shows that CPI inflation is edging up, starts edging up in China. This would limit the room for further easing, although the PBOC is seen to be continuing to adopt easing monetary policy. Yet, if in view of the global monetary tightening and also the rising inflationary pressure within China, we are afraid that further easing may be limited. So as a result, we lower our GDP forecast growth for China this year. From last time, we forecast China's GDP can grow at 4.9% for the whole year. Now we lower our forecast growth to 3.5%, much lower than the 5.5% target set by the government for this year. Okay, China Yuan outlook. Last time we pointed out that Yuan will be under pressure because China is at a completely different stage in the economic cycle to the US. The Fed is focused on fighting inflation by raising interest rates, while Beijing's priority is supporting the pace of economic growth and is expected to adopt a loosening policy. The PBOC is expected to cut interest rates further, which will widen the gap between US and China. The yield on 10-year US Treasuries is actually now higher, 40 basis points higher than on China government bonds. So this will also exert downward pressure on the Yuan exchange rate. Besides that, Beijing's strict adherence to its zero COVID policy, which is adverse to growth, and also an imploding property sector and a large government funding gap will continue to weigh on growth. From the growth perspective, if China's growth slows down, it will also pressurize the yuan. Okay, we saw a sharp depreciation of the yuan against the US dollar because of expectation of rate hikes in the US and also the strong rally in the US dollar. So we expect, we forecast, this is our yuan forecast range for the rest of the year. We do expect the yuan will be kept under, will continue to be under pressure. We forecast a range of 6.7 to 6.85. So up till now, the yuan received support at the 6.8 yuan to $1 level. But we are afraid that if there are further lockdowns and also if the growth did not turn out to be expected, the recovery did not turn out to be expected, then the yuan may drop below 6.8, the support 6.8 support level to 6.85 versus the US dollar. Okay. For the third quarter, sorry, this should be Q3. Q3 Shanghai Composite Index. Our forecast range is 3050 to 3490. In April, we forecast the range to be between 3000 and 3400. Actually, the actual index range is very close to our forecast last time, because the Shanghai Composite Index dropped to, but on the downside, it dropped slightly more than our forecast 3000 point support. It dropped to around below 2,900, and subsequently saw a strong rebound to 3,400. So for the third quarter, this would be our third quarter forecast range. We're expecting a range of between 3,050, 3050 around here to 3490 around here. Okay. Also, this should be the forecast range for the Shenzhen Component Index for Q3. Is a typo error here. It should be Q3. Our forecast range is 11,650, which is around here, to 13,550, which is around here. So we expect a range here. Okay. For Hang Seng, our third quarter forecast range is 19,200, which is the low seen in May. We expect support around 19,200, and we expect resistance around 22,000. So our forecast range for Hang Seng Index in the third quarter is between 19,200 and 22,000. For the Hang Seng Tech Index, our forecast range for Q3 is 3,960, around here, 10% below the current index level, and we expect the resistance to be around 4,900, around here. Also about 10% higher than the current index. So we expect either 10% either way for the Hang Seng Tech Index to move either way in the third quarter. Okay. Stock picks, actually this time because of the launch of the A-share ETF, the ETF Connect, now foreign investors can have access to ETFs listed on the Shanghai as well as the Shenzhen exchange through Hong Kong EX. You can also buy through Phillip Singapore, through Hong Kong EX, those qualified ETFs. So southbound, there are only 4 ETFs listed in Hong Kong that are qualified for investment. 4 big ones, namely the tracker fund, 2 ETFs tracking the Hang Seng, and also 2 ETFs tracking the Hang Seng Tech Index. So the 4 indexes that are eligible for southbound fund flow are mainly index ETFs. But there is a wider choice across the border, because close to 89 ETFs listed on Shenzhen and Shanghai bourses are eligible for foreign investors to invest. Many of them, those ETFs are thematic ETFs. So they are a mixture of index ETF as well as thematic ETFs. So today we recommend 3 thematic ETFs that are quite unique, quite distinctive for the A-share market. So investors may not find similar ETFs in other exchanges. The first one is the Penghua China Securities Wine ETF. Wine, China is very famous for its white wine, 白酒. So this ETF mainly tracks the index, the wine index. The stock code is 512690. This is an ETF listed on the Shanghai Stock Exchange. Because we can't find English and because of the time constraint, we apologize for not translating this key fact sheet. This is the key fact sheet of the ETF into English, but here I can explain briefly about the key facts. This is the stock code 512690, and the ETF was launched in 2019, March 2019, up to March, end of March, because it's a quarterly key fact sheet. The fund size, the AUM, is close to 6 billion yuan. 6 billion yuan. Manager is Penghua fund manager, and the management fee is 0.5% per annum. There's no subscription or distribution fees, and the benchmark is the CSI Wine Index 中证9指数收益率. This is the benchmark used for comparison for this ETF. Okay, so the custodian is CCB, China Construction Bank, and it pays dividend, but only once since launch. It paid 35 cents so far since launch. Okay. And there's no redemption fees. Okay. These are the top 10 holdings of the ETF. Guizhou Maotai accounts for more than 15% among the top 10 holdings. So I think you are very familiar with Maotai, as well as Wuliangye, which accounts for more than 10% of the top 10 stock holding, followed by Luzhou Laojiao, Shanxi Fenjiu, Yanghe Gufen, Jiuguijiu, Qingdao Pijiu. So not only white wine, beer manufacturers such as Qingdao are also included in the holding list, and Jingxi Yuan, and also Chongqing beer, and Gujing Gongjiu. So if you are upbeat on the wine industry, the prospect of the wine industry in China, I think this is one ETF that is worth looking at. Okay, this is the performance of the ETF. So you can see year to date, it was down close to 9%, close to 10%. Yet if we compare with the CSI 300 index, it outperformed the CSI 300 index, which has dropped 14% year to date here. And for the last 6 months, it was flat, while the CSI 300 has dropped more than 10%. Last 3 months and last 1 month act out quite satisfactory performance. It was up more than 10% for the last 3 months, and close to 3% for the last 1 month, outperforming the Husen 300 China CSI 300 index. Okay, Even compared with the benchmark, it also outperformed the benchmark. Benchmark for the last 3 months was up 9.66%, while this ETF was up 10.32% for the last 3 months. For the last 1 month, the benchmark was up 2.17%. This ETF was up 2.91%. So this chart shows that this blue line represents the Penghua wine ETF lah. This Penghua wine ETF, it outperformed the other, both the CSI 300 as well as similar the stocks, the average of similar stocks. Okay. The other ETF, Asia ETF we recommend is China Southern CSI New Energy ETF. The stock code is 516160, also listed on the Shanghai Stock Exchange. It was launched in January last year, 2021, and the fund size up to end of March was 2.5 billion yuan. 2.5 billion yuan. Management fee was only 0.15% per annum, and the benchmark index is the CSI New Energy Index. Okay. Custodian fee also lower than the one just we showed you just now, 0.05% per year, and the custodian bank is Agricultural Bank of China. No dividend payment so far since launch. Okay. So what are the top 10 holdings of this ETF? Longji Lüneng, which is a market leader in solar battery manufacturing. And Lingde Shidai, I think you must be very familiar with this manufacturer of new energy vehicle, electric vehicle batteries, lithium batteries. 恩捷股份、通威股份、阳光电源、赣锋锂业。赣锋锂业 is also listed in Hong Kong, a manufacturer of lithium and also electric car batteries. Others include TCL 中环、华友钴业、依伟锂能 and 天齐锂业。天齐锂业 is just listed duly is a duly listing on the Hong Kong exchange this week. So you get the market leaders in the lithium industry in this ETF. Okay, the performance wise, in the last 6 months it was up close to 7%, outperforming apparently versus the CSI 300, which dropped more than 10% in the last 6 months. Compared to the benchmark, it also slightly outperformed the benchmark. The benchmark rose 6.35%. Okay, last 3 months up 35.5%. Last 1 month up 12.9%. Clearly outperforming the CSI 300 as well as similar stocks average, the average of similar stocks. Okay, so this chart also shows that the blue line represents the price movement of this ETF, South China CSI New Energy ETF, and the other two lines represents the CSI 300 index as well as the average performance of similar stocks. Okay. Okay. The third ETF that we recommend to you this is Harvest CSI Rare Earth. Let's see what's the industry ETF. Harvest CSI Rare Earth Industry ETF. Because this is also very distinctive for China. China owns a lot of rare earth, although other countries also possess a lot of rare earth reserve in their countries, but because the mining of rare earths is very polluting to the environment. So a lot of countries such as Japan, the US, as well as Australia, they set very stringent requirements on rare earth mining. So it benefits China as one of the major exporters of rare earth in the world. And also the rare earth industry is tightly regulated in China. Only the state-owned enterprises are allowed to own mining rights of the heavy rare earth resources. So this is one channel of investing into the rare earth industry in China. If one is upbeat about the outlook of the industry. So the stock code is 516150, also listed on the Shanghai Stock Exchange. It is managed by Harvest, Jiashi Jijin, Harvest Asset Management. The ETF was launched in March last year, March 2021. Up to end of March, the fund size was 2.5 billion yuan. Management fee was 0.5% per year per annum. The benchmark index is the CSI Rare Earth Industry Index. CSI Rare Earth Industry Index. Custodian bank is CCB, China Construction Bank. Okay. So the top 10 holdings of the ETF include 北方稀土、中国铝业、盛兴锂能、盛和资源、包杠股份、金丰科技、厦门钨业、岭一制造、五矿稀土 and 卧龙电区. Among these 10 top holdings, I can recognize 北方稀土、中国铝业、包杠股份、厦门钨业 and 武康稀土. These 5 companies are all state-owned. So these are, I mean, state-owned companies are in a sense more solid than private-owned enterprises, and also they are given the rights, the exclusive rights to mine rare earth in China. Okay, in terms of performance, year to date it was down close to 11%, still outperforming the CSI 300, which has dropped 14% this year. And for the last 3 months, the performance was quite outstanding. It was up 21% in the last 3 months, outperforming the 1.4% rise on the Wuxi 300 指数, and also slightly outperformed that of the benchmark, 20.54%. And for the last 1 month, it was up 3.4%, also outperforming the broad market index. Okay, so this is the relative performance chart of this ETF versus the Wuxi 300, as well as the average of similar stocks. Okay. Okay, so these are the 3 A-share ETFs we share with you this time. Then we move on to DLC trading opportunities in Hong Kong stocks. Namely, we'll cover Alibaba, Tencent, Meituan, Xiaomi, BYD, Geely, and Wuxi Biologics. These are the underlying stocks that I will talk about in the next 10 to 15 minutes. So Alibaba, the worst could be over because it underperformed other tech stocks for quite some time because of worries of tight regulation and also the rumors again about Ma Yuan, the founder. But recently, it seems that the worst, there are fewer bad news and more good news. First of all, Beijing signals support to internet giants as the curbs ease, ending an 18-month-long regulatory storm against the technology sector. So there's this change in policy stance, which is signaled by the comments of the two highest leaders in China. Premier Li Keqiang said in a State Council meeting on April 27 that China would promote the development of its platform economy, its internet economy, to create more jobs and revive the overall economy. And President Xi Jinping said in a top economic meeting this week, large payment and fintech platform enterprises should be supported in better serving the real economy and smoothing the dual circulation, 双循环, of domestic and international markets. Another positive development is about Ant Group, Ant Financial. The PBOC has accepted Ant Group's application to set up a financial holding company, which is a key step in finishing a year-long revamp of Alibaba's fintech business after the withdrawal of IPO listing in Hong Kong, the calling off of the listing. But it is believed that after the revamp of Ant Group, it will revive its stock market debut. It will apply for the listing again, either in most likely, I think, in Hong Kong. Yet there's some new headwinds emerging. Just happened, I think, 1 or 2 days ago. There's about the regulatory inquiry over leak of personal data of 1 billion Chinese citizens, which may involve Alibaba's cloud service. That's why its share price dropped quite substantially on Friday, which was a response to the news I mentioned just now. Otherwise, its share price actually outperformed in the last 1 month or so, rising to about 121 Hong Kong dollars. So these are the support level, our forecast support level, as well as resistance level. Because for DLC, you can either do go long or short. If you are bullish, then you can buy a long contract. If you are bearish, you can do an inverse one. So here I share with you our forecast support and resistance level for as reference for your trading of DLCs in Singapore. Near-term support, we expect around 100 Hong Kong dollars, which the 50-day as well as the 100-day moving average now lie around $100. And the key support will be $80, the low seen in May. Okay, near-term resistance 120 here, 120, which actually had tested, which it had challenged in the last 1 month or so. It had tested a few times the $120 resistance level. If it manages to rise above 120, then the next resistance, key resistance level is 135, slightly above the 250-day moving average. The 250-day moving average now lies at 130. Okay, Tencent, we are not so upbeat. Now we change our stance. We are more upbeat on Alibaba and less upbeat on Tencent because of stalling growth. First quarter revenue declined compared to the previous quarter, revealing that Tencent is struggling not only in its gaming segment, but also in its online advertisement segment. Okay, And Tencent games were absent from the 3 batches of new games approved this year. So in the market watches very closely the new games approved every month. So starting from April, the Chinese government has resumed approval of new games starting in April this year. So April, June, and July, there were 3 batches of new games approved. Yet among these 3 batches of new games approved, so far Tencent games were excluded. So this is a negative for Tencent. The other overhang, a big overhang on the share price is major shareholder Naspers, which owns 29% of Tencent through process, has said it would gradually sell Tencent shares to fund repurchase of its own share. So once news is out, you can see that Tencent share price was under pressure because of this overhang. Now, technically speaking, it has dropped below, it has breached the support of the 50-day moving average. And we also see so-called death crosses between the 10-day and 20-day moving averages, dropping below the 50-day moving average. So we expect near-term support. Now is very near the near-term support, which is around $325. Also seen in May, the low level seen in May. So this is a near-term support. If it breaches the support of 325, we expect the other key support to be 295. Between 295 and 300 would be the next key support. As for near-term resistance, we expect resistance around 360, which is also where the 50-day moving average lies, 360. Key resistance is expected around $400, which it has briefly tested in June, before the announcement of the news that Naspers intends to offload, to dispose of the Tencent shares. Okay, Meituan doing so far, doing well so far, maintains healthy growth. First quarter revenues increased by 25% to 46.3 billion yuan from 37 billion yuan for the same period of 2021. Its food delivery and in-store hotel and travel segments achieved an aggregate operating profit of 5.1 billion yuan, up from 3.9 billion yuan for the same period of 2021. So these are the core business, existing business, all doing well. And revenue of new initiatives and other segments, which include Meituan Select, Meituan Youxuan, Meituan Insta Shopping, and Meituan Grocery, 买菜, Meituan 买菜, Meituan 好货, increased by 47% year-over-year to 14.5 billion yuan, mainly driven by the expansion of the goods retail businesses. However, these new initiatives are still losing money. So Meituan is still nurturing these new initiatives. But one saving grace is the operating loss for this segment narrowed sequentially to 9 billion yuan, with operating margin improving to negative 62.3%, primarily attributable to stronger cost control and operating leverage in the goods retail businesses. Okay. So it also outperforms the tech index, rising to above 200 Hong Kong dollars in June, but lately, because of the correction, market correction, it dropped to below 180. We expect back near-term support at 170, which is where the 100-day moving average lies. This black line, 170 near-term support. Key support will be 150, the low seen in May. Near-term resistance will be 210, which it has briefly tested in June, and if it manages to break above $210, the next target would be 235. 235 would be somewhere here. Yeah. Okay. Xiaomi, there are some silver linings in its first quarter results. First quarter revenue actually decreased 4.6% year-on-year to 73.35 billion yuan as COVID and parts shortage hurt its smartphone sales. And Xiaomi reported a loss of 587 million yuan as compared with a profit of 7.79 billion yuan for the same period of 2021. But on the brighter side, it sold 19.5 billion yuan of non-phone IoT, Internet of Things, and lifestyle products in the first quarter, including TVs. So it's not solely dependent on smartphones. Non-phone Internet of Things and lifestyle products brought about close to $20 billion worth of revenue for the company. And its internet services revenue, which includes advertising and gaming, rose by 8.2% to $7.1 billion. 1 billion yuan. It continues to strengthen global operations and advance overseas strategy to benefit from higher growth in overseas markets. So in the first quarter, international sales accounted for 51.1% of its revenue, up from 48.7% in the fourth quarter last year. So it's not highly dependent on the China market. Now, international sales account for more than 50% of its revenue. Xiaomi has already announced that it's entering the electric car market. It's planning an electric car plant in Beijing, which will be built in 2 stages. And we have the capacity for 150 cars, electric cars in the first phase, and then 300,000 once after the completion of the second phase. First Xiaomi electric cars will be manufactured in 2024. Okay. Near-term support, because its share price after the announcement of the first quarter result, its share price strengthened and rose back above the 100-day moving average and stayed there for almost 3 weeks until lately dropped slightly below the 100-day moving average. We expect near-term support at 1130, which is around here. 1130 is around the low seen in June, and key support at 1030, which is the year low seen in May. Near-term resistance expected at 1370, somewhere here, and key resistance is $15, which is also the high seen in March, the peak seen in March. Okay, then we move on to the automakers, BYD. One piece of good news is it has surpassed Tesla. BYD sold 641,000 new energy vehicles in the first half of 2022, up more than 3 times year-on-year, accounting for between 53.4% of its 2022 sales target. Because it has set a sales target of between 1.1 million and 1.2 million units for 2022, which almost double the 600,000 units sold in 2021. So BYD has set a very aggressive sales target for 2022. Yet so far it has achieved more than 50% of the full year sales target up to June, end of June. BYD beat Tesla because Tesla only sold less than 600,000 vehicles, new energy vehicles in the first half. So in global deliveries of electric vehicles in the first half of 2022, BYD actually ranked #1 in the world. This is attributable to the fact that its factories are located throughout China. Hence, it's being insulated from the disruption of COVID lockdowns in Shanghai. And by comparison, Tesla, it has only one factory in China, the Shanghai Gigafactory. And this factory faced severe production constraints amid the Shanghai lockdown. Because of faster growth in new energy car sales, BYD's market share of the new energy vehicle market is expected to rise to 25% in 2022 in China. It means for every 10 cars manufactured in China, BYD will count for 2.5 cars, 2.5 units. Okay, the company also has issued a positive profit alert lately. First half net profit is estimated to be 2.8 billion to 3.6 billion yuan, up 138% to 206% as compared with the corresponding period last year. The rapid year-on-year growth of its new energy vehicles resulted in a significant improvement in profitability. So this enhanced profitability is brought about by the rapid growth of its new energy vehicles. So there's economy of scale and partially offsetting the profitability pressure brought by upstream raw material prices. In terms of handset components, because BYD, besides making cars, it also make handset components and also provides assembly services. So in terms of handset components and assembly business, the demand in the consumer electronics industry was still weak, but the group's profitability recovered due to the improvement of cost control capability and product structure adjustment. While there are positives, positive factors for BYD, there are also negative factors. That is whether Buffett will exit. Its share price doubled in value after a 3-month rally, which I'll show you later through its price chart. But lately, there are rumors that Warren Buffett's Berkshire Hathaway will sell its stake in BYD, and these rumors have erased nearly all the car makers, all its stock gains for the year so far. Buffett, is worth to note that Buffett first invested in BYD in 2008, purchasing 225 million shares for $230 million. Now his stake was worth on 7 July, before the rumor came in, before the rumor broke out, before the share started the slide, his stake was worth $9.3 billion. So if this disposal is true, it will certainly have a negative impact on BYD share price. Okay, so this share performance shows that its share price tumbled from close to $330 to 261. Recent low was 261, seen on Wednesday this week, because of the rumor, worries that Berkshire Hathaway will dispose of BYD shares. But after the announcement of the positive profit alert, you can see that the share price rebounded quite strongly, but still met resistance around the 300 Hong Kong dollars level. Near-term support, we expect near-term support here, 260, where the 250-day moving average lies, and key support level is 245, somewhere here, below the 100-day moving average. Near-term resistance, we expect resistance around $300, and key resistance is expected at $330. Okay. Geely, In the first half of 2022, Geely Auto sold a total of 613,842 vehicles, down 3% compared to the same period last year, and accounting for only 37.2% of its 2022 sales target, which was set at 1.65 million units. Actually, for the last 2 years, Geely did not manage to meet its sales target already for 2 years. So this would be the third year whereby Geely may miss its sales target again. In the first half of 2022, Geely sold a total of 114,910 new energy vehicles, surging 4.2% year-on-year and accounting for 18.7% of its total vehicle sales. Geely has adopted a multi-brand strategy, comprising the Geely brand, Link, Zeekr, and Livan. The Geely brand sold 500,282 units in the first half of 2022, of which its EV brand, electric vehicle brand, known as Geometry, sold 54,481 units, which was 293% more than a year ago. So among the 600,000 or so units sold in the first half, more than 500,000 are under the Geely brand. Okay, Link and Co, Geely's jointly owned brand with Volvo Cars, sold 77,258 vehicles in the first half this year, declining 28% year-over-year. Quite disappointing, the performance. Zeekr, Geely's high-end EV brand, delivered 19,000 vehicles in the first half of 2022, and there's no comparable data for 2021 because this is a new brand. Livan, Geely's jointly owned brand with Lifan Auto, another automaker in China, sold 17,292 vehicles in the first half of 2022, and there's also no comparable data for 2021, as this new jointly owned brand is a new jointly owned brand. Okay, Geely share price underperformed its peers for the until May. Its share price was performed very badly until May. But since May, it's posed a strong rebound, thankful to the stimulus policies announced by the Chinese government starting from May into June. I will go through those policies later. But its share price met resistance near the 250-day moving average, which is currently at $19.50. Near-term support, we expect near-term support around $15.50. That's around this level. And key support is expected at $13.50, where the 100-day moving average lies here. Near-term resistance expected at $18, recent high, and key resistance expected at $20, where the 250-day moving average stands. Just now I mentioned China, the Chinese government has unveiled a slew of stimulus policies to revive the auto market and stimulate consumption. Car purchase, for instance, car purchase tax for passenger vehicles priced at no more than 300,000 yuan and with 2-liter engines or smaller are cut by half. The tax are cut by half, effective from June 1st to the end of this year. And purchase tax exemptions for NEVs, new energy vehicles, may be extended after the expiry end of this year. So because just now I pointed out that new energy vehicles only account for 18% of the car sales of Geely. So without this car purchase sin tax reduction, which is applied both to traditional fuel cars as well as new energy vehicles, Geely would not benefit without the tax reduction. But with this car purchase tax reduction, which is also applied to traditional fuel cars, so that means about 82% of the cars sold by Geely would also benefit under this new tax cut policy. According to the State Council, vehicle purchase tax cuts nationwide could total 60 billion yuan by the end of 2022. That means it will save, there will be a saving of 60 billion yuan for car buyers of new cars. And on top of that, in order to stimulate job creation as well as stimulate consumption, we also noticed that local authorities, local governments, as well as car makers are also providing promotional offers, subsidies to fuel sales. So that explains why the auto industry, the car stocks perform so outstanding, so impressively in the last 2 months. It's supported by stimulus policies that will continue to the end of this year. Okay. Last stock to talk about, Wuxi Biologics. It's 2269. It saw record growth and profitability in the last year. Revenue increased by 83.3% year-on-year to more than 10 billion last year. Net profit grew by more than 100% year-on-year to 3.5 billion yuan. Total backlog grew more than 20% to 13.5 billion. And the group continued to expand its customer base. Total number of customers increased to over 470, including all the top 20 global large pharmaceutical companies. And the number of non-COVID-19 projects grew to 447, with strong revenue growth and expectations, demonstrating the group's robust business momentum, even without COVID-19 projects. Okay, but there's one uncertain factor that impact the share price. That is it is being included. It is listed on the unverified list, the US unverified list. Its units, Wuxi and Shanghai, its units in Wuxi and Shanghai were among 33 entities added to the US Commerce Department's unverified list in February this year, because the US stated that it could not conduct on-site inspections to verify information related to them and also US items shipped to these companies. Okay, but according to a US Commerce Department official, Chinese authorities recently allowed a US export control officer to conduct inspections of at least one company in the city of Wuxi, which is speculated to be Wuxi Biologics. So if the US deems the check favorable, it could be possible that Wuxi, the two units in Wuxi and Shanghai, will be removed from the list, and this will remove the overhang impacting the company. Okay, last 2 months, its share price rebounded very strongly, but met resistance near the 250-day moving average. So we expect near-term support around 70 Hong Kong dollars, 70, and key support is expected at 62 Hong Kong dollars, where the 100-day moving average currently lies. Near-term resistance, 90 dollars, where the 250 moving average stands, and key resistance is 105 Hong Kong dollars. Okay. Okay, thank you. So that ends my presentation today, and we have 10 minutes for Q&A. Okay, our CE, Chief Executive, announced Hong Kong to open up by November. How would this affect the strength of the Hong Kong stock in general? Yet to be seen because opening up whether opening up will be followed by a lot of inflow and outflow of inflow of tourists, and also a lot of Hong Kong people traveling abroad. Whether we'll see this is yet to be seen. But there are certain stocks that already run ahead of the this news. That's our Cathay Pacific. You can see Cathay Pacific, despite the quarantine control in Hong Kong, which is more stringent than other countries. You realize that Thailand, Cambodia, or even Singapore has opened up, has relaxed the quarantine control. Yet Hong Kong is still upholding this quarantine control. But Cathay Pacific share price outperformed the market. Its share price has risen around. This is weekly, weekly index. Can we change to daily? Let's change to daily. So year to date, it has risen more than 30%. So we do expect the opening up will benefit Cathay Pacific, and the share price will continue its uptrend. We are looking at a $9.50 target, Hong Kong dollar target for Cathay Pacific. Okay, the next question: what is your view? What is your viewpoint on delisting issue? Just now, I already listed in my PowerPoint. Now it's reaching a critical point because the deadline is closing in. I think it's not easy. It may not be easy for China and the US to reach an agreement, because now the US seems to be taking an upper hand because it's more. It affects the Chinese companies more. So it depends which party is more is having an upper hand. So unless China is willing to cave in to the request made by the US, then I think an agreement can be clinched. Both Alibaba and Tencent have been slapped with fines recently. How to say that they are easing on the tech company? No, I don't think we should read too much into these recent fines. Because these recent fines are, first of all, the amount is very small, about 500,000 yuan per case. So it's not the kind of hefty fines. And also it is the fines against mergers or investment made in the past that they failed to disclose or report to the authority. So the policy is already there. It's not a new policy. It's not rolling out new policies to regulate the internet companies. It's existing policies that they enforce. It's an enforcement of existing policies. And also the amount of the fines is, I would say, quite insignificant. Okay, the Big Four banks are approaching 5-year lows. Is there an opportunity to accumulate? I think this is only the share price at. Let me show you. Can you close this? Okay. CCB. ICBC, you can see from the price pattern, it all quite stable above a certain level for most of the year. Yet now it has dropped, has breached the support of those key support level. So I think it's still too early to accumulate banking stock. That means I expect more downside in the near future, because just now I mentioned this mortgage, these home buyers boycotting mortgage. If it's not resolved properly, it will result in more bad loans, problem loans and bad loans to Chinese banks, and also whether it will spread financial contagion to the banking system is yet to be seen. Because currently there's this worry. So you see the sell-off starting the last few days. So we don't. I personally, I don't think this sell-off will end so soon. No, I would recommend wait and see. No need to buy banking stocks so soon. Okay, let's go back to the questions. Can comment on the two big Alibaba, Tencent. Just now talk already lah. You can refer to my slides. What are the key support level and the key resistance level? I think both Tencent we are less upbeat. Alibaba we think is still on an uptrend. Among the two would favor Alibaba. Okay. Can you comment on e-commerce market? Just now, there's a slowdown on the e-commerce market. June retail sales data shows that online sales only grew by 8% compared to the more than 14% growth in May. So I think e-commerce now becoming more competitive, and also the high base factor will see much slower growth in the next 1-2 years. Okay, regulators' view of tightening, and actually, if you look at my comments, the quoted comments of Li Keqiang and Xi Jinping, it is believed that this policy stance had softened, has eased, and that's why Baba's share price outperformed in the last 1 month or so. Okay, with CPI increase and the construction issues and final competition between Baba, JD, and PTT. Not only now, I think I do agree that competition among the e-commerce players will be getting more and more intense, because other than JD and PT, Pinduoduo, this Meituan just now I mentioned is also entering the e-commerce arena by offering 3 new initiatives: Meituan Select, Meituan Insta Shopping, and Meituan Grocery. And with its logistic, with its delivery capabilities, and also the subscribers they are using its delivery services. So I think Meituan is also a key rival to Baba, JD, and PTT. Okay, question number 3: with CPI increase and the construction issues and financial contagion regions, are you bullish or bearish on these e-commerce stocks? I will say slightly bullish, not absolutely bullish, because for China, yes, to continue to support and stimulate the economy. And one of the measures to stimulate the economy is to fuel consumption. So consumption policies stimulating consumption will also benefit e-commerce operators to a certain extent. Okay. What's your view on the any analysis on Ping An Insurance? Ping An we have dropped from our buy list because of his performance lately, financial performance. Actually, we think China Life performs better than Ping An, and also because Ping An exposure to the property market. It has invested in some property developers in China, and it will inevitably be impacted by the debt problem of those property developers. That accounts for the underperformance of its share price. So among the insurance companies, I think our top pick at the moment is AIA, 1299. It's also expanding in China. So and also it's more balanced. It has a more balanced business portfolio spanning Hong Kong, covering Hong Kong, Malaysia, Thailand, and Singapore. So I think the AIA is a safer bet. Xiaopeng, Baba, we have talked quite a lot. So I want to take the question about Xiaopeng. Xiaopeng, among the three new force, EV force, 造车新势力, I think Xiaopeng, the profit margin is the lowest among compared to NIO and Lixiang. So if you ask me to rank, our topic is not Xiaopeng. Our topic is still remains Lixiang, Li Auto, especially after the launch of a new model. Previously, it only has one Lixiang One, Li One. Now it has another new model attacking the SUV segment. So we are more upbeat on Li Auto compared to Xiaopeng. Okay, Lynette Lim asked me to comment my views on BYD, still a buy. Speculation is pulling out. Also views on Meituan, please. Okay, BYD short-term uncertainty. There's uncertain the overhang of the, but long-term, as also illustrated by the positive profit alert, its profitability is improving. So with a higher profitability, we reckon that BYD is still a buy. We recommend two strategies for the investors who want to play safe. You can wait until after Warren Buffett sold all his shares. Then to avoid the risk of buying before Warren Buffett sells his shares, or you can set a relatively defensive price to buy BYD, which is around $260. So these are the two strategies we recommend buy. Certainly, we still think the company is still a buy, but we advise two strategies regarding the setting the buying price. Okay, as on Meituan, just now our slide shows that the company still manages to maintain healthy growth. The core business are doing well, and new initiatives, we do expect that it will catch up and the losses will narrow over time. So it's still also a buy for Meituan. Views on JD.com, Alibaba, and Tencent. JD, okay, let's look at the share price. Actually, JD, can you close it? Okay. We also like JD because less uncertainty surrounding Jack Ma, if that is negative to the share price. You can see that it also benefits from the 618 e-commerce festival lately, and it recorded good business, good GMV, still good GMV. So we see the near-term support at 230, and the next key support level will be around 215 and 230. Also a buy on our is on our buy list. Also a buy. Okay. Okay. One last question as time's up. Is there an ETF focus on China green economy you recommend? I think the new energy ETF is also related to the green economy, the double carbon, 双碳, because it comprises battery, electric car battery manufacturers as well as solar battery manufacturers and wind power. Jingfeng is a wind power equipment manufacturer and also operators of wind farms. This let me repeat: China Substance CSI New Energy ETF. The stock code 516160 is also related to the green economy. Okay, so thank you for your time. Look forward to seeing you again in the fourth quarter. Thank you.
Thank you so much, Louis, for the insightful sharing. We have now come to the end of the webinar, and we would like to thank all of you for joining our Strategy and Stock Picks webinar. For the session just now, we will be uploading the recording on Phillip Capital's Facebook and YouTube page. You may view the recording of the webinar on your own time. Also, we have many other interesting webinars going on almost every other day. You can view the full list of our free webinars on our website. Do take your time to fill in the survey so we can improve your experience with us in the future. You may scan the QR code on the slide or copy the survey link posted to the chat tab. You may also join our investing communities to get free access to full research reports on discussion and technical analysis. Once again, thank you for joining us, and we hope to see you for next quarter's Strategy and Stock Picks in October or any other future events. Take care and have a nice weekend.